Right, so you're basically like establishing like the weekly draw in terms of, in my case, you know, seeing what consecutive bar pushes in play as of the most recent weekly bar close, how that most recent weekly bar closed the way however it did amongst whatever consecutive bar pushes in play, labeling the features to that bar, and then pairing that up with the context of what nearby POIs are around, with the context of how the recent bar closed the way it did, however it did, showing like what sort of intent exists with regard to how market participants are willing and inclined to trade the underlying product at the region and prices at the weekly close the way it did at. Does that coincide with, for example, some POIs which are like prone to attract distinct sort of interaction with the market at these key regions, you know, and then pair that with how they actually ultimately did trade, like, and then in my case also pairing that with the TT trades thing, did it how it closed the way it did amongst or relative to the previous bar close, did it close above its high, did it close below its low, you know, and then doing that on the dollar, on the euro first, and then the dollar, to assess probable capital flow in the dollar, and then ultimately assess what probable capital flow it is that's likely to go on within the dollar, by the same, utilising the same, undertaking the same sort of steps, aka following the same sort of protocol, and yeah, and then basically looking for the appropriate framework that, like, to get on board that weekly probable draw, like, or weekly probable, like, direction that the bar's poised to move in, you know, like, for example, like, see the consolidation, like, also around the economic calendar, see the expansion, see the manipulation at post consolidation, either before the news or after the news, or on the news, and then look for the displacement. What I was also possibly thinking of implementing was Tom Howgard's fishing technique, so I'll show you what I mean for the entry. I really am thinking of this. I got the idea today, in fact, and yeah, then looking to capitalise on your piece of the probable direction that the weekly bar is likely to expand towards, by hunting that, like, I don't know how to explain it, like the sort of framework that, like, the basically, I don't know how to explain it properly, but like the consolidation manipulation thing, you know, that's, in order for how the weekly bar would likely to form in a probabilistic way, you would have to have that form first, you know, and I think it's irritating the fuck out of us that I can't explain it. Basically, the reason how it's like long-term feasible, let's say, is because your trade frequency is so low due to the economic calendar. It's rooted in absolute sound logic, you know. You're literally getting involved where people are getting wrecked, first of all, too. There's some more logic. You've always been told get in where people get out, in terms of where people are stopped. David Ball, Tom Howgard's mentor, taught that. Also, so here's your pros. You've got absolutely pristine frequency, you've got pristine probability, you've got pristine logic, there's like barely any negatives. There is actually no negatives, in my opinion, due to the fact that you shouldn't be FOMO, because you should be more than happy with 1.5% on a 1.5 hour trade is like what? It's like, hang on, damn, there we go. I don't even know the math. It's like what? It's about 2.5% or something, is it? Yeah, so basically, in short, right, you've got, it's like according to your risk, you know, you could, in fact, you could have like two accounts. You could have like 125, due to the probability of the trades playing out. You could have two accounts. You could have one which is a more, like, play it safe. I don't know the right term, I'm not really on it today with articulation, really. But you can have a more play it safe account and possibly risk like 1% to 1.5 to 1.25%, right? And you know, target whatever you are. In my case, it is a variable risk to reward, but usually you're looking at about 1.5 to 1.8 R, right? Which is perfect. Anyway, you know, and then you could also have a secondary account due to the probability of these trades playing out and the frequency, where you could risk 2.5 to 2, you know, and you could be a little bit more like take on risk.